Hey everyone, welcome back to Corporate Decoder. Today we're diving into Guggenheim Credit Income Fund's latest report. Get ready because after reading this, you might feel like you need a financial decoder ring just to understand what's going on. But don't worry, we'll simplify it for you. This report basically says things aren't looking great. The fund is losing money and a liquidation plan, basically a wind down, is underway. So what does all of this mean for investors? Let's break it down. Before we get started, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Come join us after the video. First off, this is a Form 10Q, which is a quarterly report that companies file with the Securities and Exchange Commission, or SEC. Think of it as a checkup that companies have to do every 3 months to show how they're doing. This particular one is for the period ending in March of 2025. The report covers the 3 months from January through March of 2025. It gives us a snapshot of where the company stands financially during that time. This is Guggenheim Credit Income Fund 2016T. It's what's called a closed-end management investment company. To say it simply, it's a fund that invests in other things with the goal of giving its investors income and preserving their capital or their money. It also wants to grow their money a little bit over time. Here's a key thing to know. The company is in the process of winding down. They approved what they call a liquidation plan back in March of 2021. This means they are selling off their assets and returning the money to shareholders. Now let's look at the assets and liabilities. The big thing here is their investment in Guggenheim Credit Income Fund, which they call GCIF. As of March of 2025, it's valued at about $4.2 million. But December 2024, this value was around $5 million. So as you can see, the fund has lost a lot of value. They also have some liabilities or debts, mostly in accounts payable and accrued expenses that round up to $259,000. That means bills they need to pay. Their total net assets, which is what's left over after they pay their debts, is around $4 million. Moving on to the statement of operations, which shows how profitable they are or aren't. You can immediately see there is no investment income. Their total expenses were $315,000 for the 3 months that ended in March 2025. This includes things like administrative fees, reimbursements to related parties, which means payments to companies connected to Guggenheim, trustee fees, which is payments to a person in charge of taking care of the company's assets, professional services fees, and transfer agent fees. The most important part is here. They had a net investment loss of $315,000. That means they lost money instead of making it. Comparing this to March of 2024, the net investment loss was 124, the net investment loss was 124, the net investment loss was 124. To make matters worse, there's also a net change in unrealized depreciation, which basically means the investments they hold have gone down in value. This came to $840,000. This is a major change compared to March of 2024, when they had a smaller loss of $432,000 from depreciation. Adding it all up, the net decrease in net assets, meaning how much their overall value dropped, was over $1 million. In comparison, for the 3 months that ended in March of 2024, they saw an increase of about $39,000. To put it on a per share basis, they lost 7 cents per share outstanding. Ouch. The statements of changes in net assets shows how the company's net assets have changed over time. From December 2024 to March 2025, their net assets decreased by roughly 1.1 million yuan. They started the period with over $5 million and ended with just over $4 million. Now let's look at the statement of cash flows. This shows the money coming in and going out. They have a net cash decrease, which means cash going out more than cash coming in, of $125,000. One of the risks they point out is that they're investing in securities that aren't easy to sell. They say they do not expect a secondary market to develop for its issued and outstanding common shares. As a result, the company's ability to sell its master fund common shares is limited. This makes it harder to get their money out if they need it. They have several agreements with related parties, particularly with Guggenheim, which manages the fund. They reimburse Guggenheim for certain expenses. The registration statement pertaining to its public offering of 104,041 common shares at an initial public offering price of 9.55 per share was declared effective on July 24th, 2015. From this, they have a total of 19,081 shares outstanding. There were no distributions or payments made to shareholders during the first 3 months of either 2025 or 2024. Their total investment return, which is a measure of how well the investment is doing for shareholders, was negative 22.7%. The investment is quickly losing value compared to 2024's increase in 1.68%. And finally, on March 13, 2025, the Board of Trustees voted unanimously in favor of withdrawing the company's and each feeder fund's election to be regulated as a BDC under the 1940 Act and the liquidation and dissolution of the company and each feeder fund, the special meeting of to be held on May 12, 2025, subject to any adjournments thereof, shareholders will be asked to consider and approve. I, the withdrawal by the company and each feeder fund of its election to be regulated as a BDC and the liquidation and dissolution of the company and each feeder fund, and I, the sale of certain illiquid assets held by the company to permit the liquidation and dissolution of the company and each feeder fund. I rate the sale of certain illiquid assets held by the company to permit the liquidation and dissolution of the company and each feeder fund of its election to be regulated as a BDC and the liquidation and dissolution of the company and each feeder fund, subject to any adjournments thereof, shareholders will be asked to consider and approve either withdrawal by the company and each feeder fund of its election to be regulated as a BDC and the liquidation and dissolution of the company. So what's the big picture here? It seems like Guggenheim Credit Income Fund 2016T is facing some serious challenges and they are in the process of closing shop. The losses have accelerated, and with the liquidation plan in motion, investors are likely bracing for further changes in asset values. This means the value on shareholders' investment statements has decreased as liquidating distributions have been paid, so it might not be a fund to put money into right now. From just this report, it's hard to say if this was caused by bad investments from the start or the economy changing quickly, but numbers don't lie, and in this case, the trend isn't pretty. Alright, that's our breakdown of Guggenheim Credit Income Fund's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.